Good morning. This is Larry Edelson with my Uncommon Wisdom weekly market video update for Thursday, January 13th. First, a couple of notes. I'm sure you all received my flash alert that I sent out last week regarding the very high probability that China will be revaluing its currency higher this year and probably sooner rather than later. This is very important that you stay tuned to this. It's going to have rather gargantuan ramifications and consequences on all markets because when China revalues its currency higher, it essentially means that the dollar, the US dollar, is getting devalued against that currency. So please stay tuned to my recommendations and market updates on this coming event. I do believe it could happen any day. I do not know the exact timing. However, I'm beginning to see subtle signs that it, as I just mentioned, will probably be sooner rather than later. First, the yuan has been creeping up over the last week or so in forex trading against the dollar. And secondly, we have a very important meeting coming up between China's president and President Obama just a week from now on January 19th. Of course, there will be a lot of issues on the table there, but I'm certain that the valuation of the China currency will be a main topic of discussion. Also, very, very significantly, the Bank of China just announced today that it will begin trading the renminbi, which is the sort of fancy name for China's currency, the yuan. It will begin trading the currency in New York in the forex markets. Now, previously HSBC Bank has traded the yuan on a limited basis in the United States, but this is the first time that a China-owned, China-based bank has announced that it will begin trading and making markets in the currency in the New York forex markets. This is, in my opinion, not many are talking about it, but I think it's very, very significant. We're beginning to see the yuan take on an international character. There's trading going on in the forex markets in the yuan in Hong Kong and in Southeast Asia. Now the Bank of China, this is not China's central bank, but nevertheless it is a China-based bank, is beginning to trade and make a market for the yuan in New York forex markets. So these are very significant developments. Now let's turn right to the charts. I want to take a look here first, of course, at gold. I'm going to show you a couple of things in gold. We saw quite the sell-off over the last week or so, as I've been expecting. Now we're seeing a little bit of a bounce back. It appears that this bounce should be rather shallow. We should be making yet again a lower high, just like we did over here. This high did not exceed this high, so we had a lower high, the beginning of the definition of a downtrend, in this case a short-term pullback in gold. We will probably see a high anywhere between 1390 and maybe 1410 on the extreme side on this current rally here in gold. But I fully expect that we'll see gold begin to move lower down to 1325, then 1250. If it does not hold 1250, we could see the 1100 level. I'm not ready to get that bearish short term. Keep in mind, intermediate term and long term, I am very bullish. I want to also show you now a cycle chart from my work with the vast database at the Foundation for the Study of Cycles and some cycle analysis software. This is a composite cycle analysis of gold. It basically factors in thousands and thousands of data points and crunches the numbers through a mathematical model to determine a composite cyclical picture for gold. And as you can see on this red line here, gold did peak right on cue with this composite cycle forecast. It also, we made this is that high I referred to on the previous chart, a lower high here, which is in keeping with this cyclical forecast to the downside, which extends all the way into March 22nd. So we could see gold uh, decline all the way into the latter part of March, the first quarter of this year, where a significant low would be made, and then we would begin a new rally to the upside, which would probably see new record highs by the end of the year. I know that there are a lot of investors out there that follow me, and some are distorting the fact. They believe I've turned bearish on gold. That is not the case. I've turned bearish on gold only in the short term. I am ready and willing to admit that I'm wrong if I see the conditions, the cyclical winds and trends and market action change. However, I am not the least bit bearish on gold at all on an intermediate term and long-term basis. My minimum target is 2,300. My likely probable target gold is around the $5,000 level, and it could go even higher than that. However, we probably will not see those kinds of highs till at least next year, and possibly not until 2013 or 14. Having said that, please stay tuned to my alerts on what to do for your gold portfolio, when to start aggressively buying during this pullback, and what to buy. Now, I'd like to take you to the dollar index. This is the same chart I've been following for you previously. Just bear with me 1 second here. We have a little time delay with my software. Let me get this up for you. There we go. Okay. This is the same chart here that I've been showing you and following for you, the action for you over the last couple of weeks. You can see the dollar index has pulled back to test support on this cyclical trend channel here. It is likely to rally a bit further here as the euro continues to undergo some massive problems due to the sovereign debt crisis. Do not make any mistake about it. This does not mean the dollar is a strong currency, because it is still very weak, near record lows against most Asian currencies, and unlikely to go substantially lower against most Asian currencies, especially as China revalues its yuan higher. I would not play the long side of the dollar, because the major trend for the dollar, even against the euro, remains down. Okay, let's now take a look here. I'll pull this over for you to the Dow Industrials. Lots of sideways choppy action here in the Dow, pretty much in keeping with this rectangular box formation that I've been showing you. We did get a little bit of a spike higher on Friday of last week and Monday of this week. We still could run up to 12,000. I cannot rule that out. But the cycles and the action and the sentiment indicators in the Dow continue to argue that the Dow Industrials are rolling over, and like gold, will put in a rather sharp, unexpected by most investors, pullback, which could go as low as Dow 9,000. Having said that, again, intermediate term and long term, I am not that bearish on the Dow Industrials. I am bearish on the U.S. and European economies, but that does not mean that stocks in general, broad-based stock markets, have to go into a bear market or crash mode if the U.S. and Western economies continue to decline. In fact, there have been many times throughout history where stocks have sort of become commoditized and taken on aspects of a tangible asset, if you will, especially when public sector confidence, like we're seeing in the sovereign debt crisis and in the municipal bond crisis in the United States, begins to take investors and push investors out of publicly based, government-based, municipal-based, federal-based investments like the bond market and into other asset markets. This is especially true when you consider that the size of the bond markets in the United States is 10 times the size of the equity markets. So even if 20% of the money in the bond markets comes out and seeks some shelter in blue chip stocks and in gold and oil and other natural resources, you can see how the bond market could get totally crunched and yet stock markets and natural resource markets could continue higher, in fact much higher. So please stay tuned to this rather uncommon wisdom that I'm giving you. It is based on historical fact. It is based on precedent. It is not some wild conjecture on my part. It's simply showing you ways to look at the markets that many other investors just simply don't understand. All too often they extrapolate into the future and they carry with them, especially Wall Street, and I blame them for a lot of this because they do not educate the public. They perpetuate way too many myths in economics and in marketplaces. There are no set fast hard and fast rules. Interest rates going up does not mean the stock market has to go down. That's just one myth. So please stay tuned to my updates, my columns in the Monday Morning Uncommon Wisdom Daily, and also, of course, for more detailed timing and specific recommendations to my Real Wealth Report. If you're not a member of the Real Wealth Report, I strongly suggest you consider joining as soon as you can. This is Larry. Till next week, have a good weekend.